Okay, everyone, this is Dr. Tom Carr, aka Dr. Stocks, and I want to welcome everybody who's in the room now and who will be watching this in the recorded version to how to trade the market's hottest stocks safely and profitably. Now, before I begin, and we've got a lot of material to cover today, I want to make sure that you're able to hear me properly and that the sound is fine. You're able to see my screen, my PowerPoint. Can everybody type in a Y or a yes or good to go in? Yeah, there we go. Okay, we're good. We're good. Well, thank you everybody for coming today. And I know that some of you are members of my live trading room. Some of you are subscribers to some of my letters, and some of you I've never met before. So if you're new to my material, then I just want to thank you for tuning in today. And I hope that this next hour and a half or so of our time together is worth your time, because I certainly don't want to waste anybody's time. And I also want to announce two things before we begin. One is that after we look at a number of charts today and discuss the system, one of the systems that I use to find and trade hot stocks, momentum stocks, I should be able to leave you with 2 or 3 really good trades for you to put on either this afternoon or sometime tomorrow. And then secondly, if you hang on to the end, I do have an offer, a very deep discount offer on some of my subscription products. So if you're interested in that, you'll get more information on that at the end of our time together. There will be time for question and answer at the end. So if you find anything confusing or want more detail on anything that I say, you're able to type in that question and I'll go ahead and answer it time permitting. I do run a live trading room and I'm taking some time out from that room to do this. So I can't spend all afternoon with you. We need to get back to the trading floor, but we'll be able to spend some good quality time together. So the thing I wanted to start with today, and I am, by the way, the founder of a trading company called Befriend the Trend Trading, which is a publishing company that publishes newsletters and trading manuals and trading webinars and so on. And we founded that back in 2002. And I'm the author of a couple of books as well. Maybe you're familiar with that. You'll find those in most bookstores as well as Amazon.com. Trend Trading for a Living was our big bestseller. But before I get into the meat of what we're going to be talking about today, I wanted to share with you just briefly, and as we allow time as well for new attendees to come in, the Befriend the Trend story, the story of the company that I founded. And this was launched back in 2002, October of 2002. So we're coming up on our 18th anniversary. And I want to let you know that I launched this finance company, this publishing company, without any financial background. I was for 17 years a professor of philosophy and religious studies. I have plenty of graduate degrees, 2 masters and a doctorate, but not in economics, not in business management, not in finance. They were in philosophy and religious studies. So I came at trading, and I started myself back in 1996 with very much of a blank slate. For 2 years, I lost money, and then in my 3rd year, 1999, I started to buckle down and put myself under the tutelage of some very wise and smart traders, including William O'Neill, the founder of Investors Business Daily, and Len Zacks, the founder, MIT doctorate and founder of Zacks Investment Research. And I learned the tools of the trade. And then in 2002, we built a little website, drstocks.com, and it's still going strong today in its 3rd iteration, along with my flagship premium letter, the Trend Trade Letter. And that has been published every market day since then. So it's going strong now in its 18th year. It's got a very robust track record, about 37, 38% per year on average. And it offers our subscribers a long-term portfolio and then short-term swing trades in both stocks above $10 per share and below $10 per share. Then in 2007, And all of this, by the way, was while I was still a professor. So I was teaching full time and then scurrying to the computer in between classes to put on the next trade or do a little bit of research and that sort of thing. All with the approval of our dean, the academic dean, because she realized that by doing this, I could allow my wife to stay home and homeschool our kids. That was a big priority for us. So it was a nice, what we call today a side hustle. And the site really kind of took off. And in 2007, I launched a second letter that focused on exchange traded funds, which became even more profitable. And it's been published every market day since then. Then in 2008, I was asked by McGraw-Hill to come out with a book. So I wrote Trend Trading for a Living. That was the first edition. It just came out in a second edition 2 years ago. And it took off. I mean, much to my surprise, much to the surprise of a previous publisher who could have published it, it really became a bestseller. It was translated into Chinese and Japanese and Korean and on and on. And it drew a lot of attention to our site, and we're all very thankful for that. It got to the place where I couldn't teach and manage the business at the same time, and so I did retire or resign from teaching to devote full time to trading. In 2010, I was asked again by McGraw-Hill to come out with a sequel, so I wrote Micro Trend Trading for Daily Income, which focuses on short-term trading, and also came out with our third letter on the drstocks.com site, the Momentum letter, and it has been and is still today our most profitable letter. It's a weekly letter, and you get the three top aggressive momentum stocks, the three top conservative momentum stocks, and then the three aggressive stocks to sell short every week, every Monday morning before the market opens. So it's one of those kind of set it and forget it kinds of services where you just trade once a week and then you're good to go. And then in 2014, I came out with a third book, which kind of flopped, I guess. No one really bought it, but I consider it to be my best book. Market Neutral Trading looks at how to balance both longs and shorts in all market conditions so that you're always market neutral. And I think it's really quite an interesting way to trade. You're pair trading, so you're putting on one long and one short at the same time, and using systems that will give you both a long and a short candidate. And in any case, for whatever reason, it wasn't a very popular approach. But also that same year, I started an options letter because there was a lot of demand for some of the options material that I was teaching. And so I launched that over on a third-party site called MarketFi.com. And I'm happy to say that it is the most profitable letter offered on MarketFi.com. We do a lot of naked puts and covered calls there, so it's a bit more of on the conservative side of things, but we do some shorts, some calls and puts as well. In 2017, we launched a sister site, drstockstrading.com, and this offers two letters that are weekly, Hot Stocks letter and the Penny Stocks letter. And these are aimed at members that are a little newer to trading, perhaps. The Hot Stocks letter trades momentum stocks in the small cap variety. The Penny Stocks trade stocks priced under $2 per share. And as you can see, the track records of those have been very, very good. The Hot Stocks letter has been having kind of a rough go this year for some reason. I'm not sure why. The small cap index, Russell 2000, has been lagging some of the other indexes for reasons unknown to me. But the Penny Stocks letter has just done really well. And then today, here we are in 2020, and on our drstocks.com flagship site, we offer webinars, manuals for people who want to learn how to trade for themselves. And that probably includes most of you, because here you are taking a webinar on how to trade for yourself, right? How to find your own stocks. You don't have to pay me to do it. And then I also launched, this was last year, but I launched in 2019, a live trading room. That is offered through stocktwits.com. Many of you are probably members of StockTwits, and if you're not, that's a great resource for anyone who's new to trading and wants to learn good trading skills, I post on StockTwits all the time for free. And then I have a private room for members only where I do live trading. So people are sort of watching me trade throughout the day. And we do a lot of quick turn stocks. We do day trades. We do options. We just started doing some live trades and weekly options, going really well. We have done 20 of those so far, 15 of which have been profitable, averaging about 70% return per pick, including the losers. And we're just holding those for a few hours. So you can see how quickly the profits line up there. Now, of course, options trading carries a lot more risk than stock trading, so you have to be careful of that. But we have ways of managing risk as well. Okay, so a little bit about my background, and that gives folks some time to kind of trickle into the room. And once again, I want to leave you at the end of our webinar today with a couple of stocks that you can go right into the market and buy either this afternoon or tomorrow. And I do want to offer those of you who have not tried our newsletters before a deep discount offer on some of our annual memberships. Okay, let's jump into the webinar itself. It looks like just checking the question box here. And the only question I have so far is that, yes, there will be a recording of this, and you'll get an email with a link to that recording in a few days. Okay, let's jump into our webinar. In today's webinar, you're going to learn several things. You're going to learn, first of all, how to find the market's best hot stocks. Now, what is a hot stock? Okay, a stock can be hot for a couple of reasons. One, it's a stock that everybody's talking about, everybody's trading, everybody's posting notes on Twitter about, and it's getting a lot of attention. You'll find those kinds of stocks every day. They tend to be what we might call one-hit wonders, right? They get a lot of attention, they get a lot of volume, they shoot up in price really high, and maybe there's some news out that's driving that sort of thing. Maybe it's a biotech company that is expecting an FDA approval or a phase 3 trial to be announced, those kinds of things, right? And then once everybody's on board, the whole thing collapses, it fizzles out, and a couple of days later, it's back where it started. Okay, that's not a good hot stock. That's a hot stock, but it's not a good hot stock. We are looking for the market's best hot stocks. And by that, I mean stocks that have genuine fundamental reasons for why they are increasing in price, number one. Number two, they have a predictable future ahead of them that is also bullish. So this is not just a news flash. This is not a pump and dump kind of thing we're looking at. We're looking at quality stocks in quality uptrends with strong fundamentals that are sustainable, that their momentum is sustainable. And I'm going to show you exactly how to find those kind of stocks. We're going to do that today. Secondly, we want to determine the best entry price. It's not enough just to find a good hot stock. You need to know where and when to buy it. I'm going to show you how to do that. And there are all kinds of ways, there are all sorts of approaches to answer that particular question. I'm going to show you a couple of approaches. So I'm not going to exhaust all of my trading skills here today, but I'll give you a couple of good tips, okay? Thirdly, I want to show you how to manage the trade. Now, this is really essential. So many of my trading clients, so many of the members in our trading room, so many of our subscribers who email me, they'll often say, you know, I got into a stock and it shot way up and I could have taken all kinds of money, but I held on too long and it went down and then I sold for a loss. Or they'll say, oh, I got into this great stock and it kind of went nowhere. It went down a little bit. I got tired of it, so I sold, and then the next day it went up. Well, those are very common problems, and if you struggle with those, stay tuned because we're going to help you sort through some of that. But really, those problems are problems of trade management. That's one of the things I do. I do a lot of private coaching of traders, and mostly professional traders who, you know, my fee for that, I need to say, starts quite high. So if you're thinking you can capture my time for a couple of hours and I help you with your trading. The fee is steep. But with my private coaching clients, that's primarily what we work on. We do the things that we're talking about here, finding the right stocks and knowing when to enter, but managing the trade, that's 80% of trading success. So we're going to look at some of the ways of doing that. And then we need to determine where do we get out of the trade? We need to determine our price target. Where do we think this hot stock is going to go in the future? No one knows the future except God. So we're not going to give you any crystal ball kinds of voodoo notes here. We're going to show you, however, some very reasonable and probabilistic ways of determining where a stock is going to peter out in the current run. That's your price target. That's where you want to get out before it starts to turn back around and pull back, okay? So we're going to learn these techniques. We're not going to exhaust them by any means. There are plenty of other resources that will help you do that, but we'll give you some good ground rules to work with. So what you're actually learning today is my 4-step process for trading good, high quality hot stocks. This is not the only process I use. I want to make that clear. You're not learning everything that I know, but this is a very solid, robust approach that I want to share with you today. So, sorry, I didn't mean the two to come out at once, but that's okay. So what we're going to do today is, first of all, learn how to scan for the right hot stocks, and we're going to be using fundamental analysis for that. So I mentioned before, there is a big difference between the kind of hot stocks that go up one day and then crash the next. We don't want those. We want hot stocks that, for very good reasons, are very likely to continue their uptrend. And I'll show you exactly how to find those hot stocks. Secondly, we're going to use technical analysis to determine the best entry price. Now, technical analysis is an analysis of the price chart itself. We're not digging down into the company. That's what we're doing in fundamental analysis. We're looking at the company's balance sheet and its earnings growth and its sales and things like that. In technical analysis, we're simply looking at the price chart. And we're using that price chart, the price history of where the stock has traded over time to determine our best entry price. And then we use technical analysis again to determine the best stop price. Now, a stop price, if you're not familiar with that, is where you will sell the stock if it goes against you. If you buy it at 200 and it goes down to 175, you'll be out. I can guarantee you'll be out because it will have hit your stop loss, which saves you from a worse loss and it protects your capital. That's what I mean by managing the trade. We need to know where to put the best stop price. Now, so many people will say to me, I use stops all the time. I believe in stops, but I keep getting stopped out of these stocks and then they go up again. Well, that's because you're not putting your stop price in the right place. And I'll show you how to do that. I'll show you some techniques for how to do that. And then lastly, the 4th step in my 4-step process is that we're going to use technical analysis again to determine the best profit target, where we think we can get the maximum amount of gain in the least amount of time, right? Because time is always against you, right? When you're trading, you don't want to be in a stock that just goes nowhere for months and months and ties up your capital when you could be putting that capital in something that's actually going up. So we want to make sure that we do have a profit target that is reasonable and won't take months and years to reach. We want something that can be reached in a few days, a few weeks. If you're a very short-term trader, then you're looking at profit targets that can be reached in a few minutes to a few hours, because we want to take that profit and then immediately put that money to work in a new candidate, a new hot stock. So we are always catching the meat of the move. We're not worrying about catching the full move itself, because that can tie us up for so many months and years. And don't get me wrong, I'm a very big believer in long-term investing. We do long-term investing in our live trading room. We do it in the trend trade letter, in the ETF trend letter. I have a whole nother service which I didn't even talk about that is aimed at long-term investors. But so I'm a big believer in that. You've got to buy and hold the best names in the business, but the trading money that you use to buy those long-term shares is going to come from setting the right profit target, and I'll show you how to do that. Okay, so here is looking at the first step of our four-step process. Here are the four fundamental metrics, the four metrics that come from fundamental analysis for finding the right hot stocks. And I said at the beginning that there's a big difference between the right hot stocks, good quality hot stocks, and everything else that has price momentum. You can't just buy things that have price momentum. Okay, I'm sorry, you'll lose money if you do that. You need to be able to dig down into the underlying company and figure out whether this company has sustainable momentum. That's what we're looking for. We're looking for a company that has some staying power, that is increasing its sales, increasing its business. And I'll show you, there are four things that we're looking for in this particular approach. There are plenty of approaches, but this is one of them. And one of the things we're looking for is growth in earnings per share, that's EPS. We want to see that growth in two forms. We want to see, let me get my pen up here. We want to see growth over the past, and we want to see some expectation of future growth. Expectation of future growth. Future growth is an unknown. Nobody knows the future except God, but there are some ways that companies and the analysts that cover them can give a reasonable estimate of where they see, all things being equal, where they see the company being at a quarter from now, or half a year from now, or a year from now. And we're able, through the genius of all the data that's available to us now, we're able to tap into some of those numbers. And we're going to use those to find high quality momentum stocks. So earnings growth, past and future, strong analyst support. This is an underestimated feature in momentum stocks. Very, very few people that I know, very few traders that I know will ever check to see what analysts are saying about the companies whose shares they're trading. This is something I learned from Len Zaks. Now, Len Zaks was and is a very, very smart guy. He earned his PhD from MIT in finance, and then he went on to found Zaks Investment Research, which has one of the best analyst firms on the planet and one of the best approaches to stock analysis that I've ever seen. And I learned from him, from Len, that there are analysts and then there are analysts. That's to say, there are really good, smart, reasonable, wise analysts who have a very strong track record. And these are analysts who, whenever they write about a stock, they're right at least 75% of the time. And in every case, on average, they earn 20 to 25% on those analyst reports. And what I'm saying by that is, for example, let's just say Joe Smith is working with ABC analyst company. And he comes out with a report on Apple and he says, you need to buy Apple because everything I'm saying looks really, really good. Now, if Joe Smith is a good analyst, Apple should go up at least 25% over the next year, maybe more. But if he's averaging 25% on each of his buy recommendations, he is a good analyst. And if he's right at least 75% of the time, he's a good analyst. And when you have both of those together in the same person, you've got a really good analyst. So there are really good analysts, and then there's everybody else. I would say probably 90%, maybe more, maybe 95% of analysts, they're not even worth looking at. There is a way of determining who are the very good analysts and who is everybody else. And we're going to use that to help us determine the best momentum stocks. Okay, you guys with me so far? Everybody okay? So we got a lot of stuff to cover. So get out your pen and paper, take some of these notes down. You'll also, again, you'll have a recording of this webinar, so you can go back over those slides here and get the material you need. So thirdly, we're looking for three things that give the company a measure of safety. Let's call it that. Warren Buffett would call this a moat, right? A measure of safety around the company that protects it from its peers, protects it from its competitors, protects it from the broader industry at large, and protects it from the market itself. If a company has three things: strong sales, and by that we mean sales growth, but that's not only what we mean. Strong sales, strong margins. You probably know there are three types of margins, right? There's gross margin, operating margin, profit margin. Not every company has a profit margin. So we're looking here primarily at operating margin, but all three of those forms of margin are important. Margin is the pricing power of the company. When a company has strong pricing power, that means it can demand higher prices for its product than other companies, other peers. That's a measure of safety. That's a moat. And then thirdly, return on equity. And return on equity, which is a measurement of how profitable a company is relative to its assets, right? The equity that it possesses. And when you have high return on equity, and it's measured as a percentage of revenue, then you have a company that has very smart, wise, conservative management. And that's also part of the moat. That's our measure of safety. So our title of the webinar today, how to trade the market's hottest stocks safely and profitably. This is the safely part of the presentation. When you've got these three things going for you, you've got a very a relatively safe play, okay? And then fourthly, relative price strength. Now, relative price strength is this is a technical term. So this comes out of technical analysis rather than fundamental analysis. So here I'm, violating my first rule. We were only going to use fundamental analysis, but we need to include this in our scan that we're going to be building here in just a minute. Relative price strength is the strength of the stock relative to the S&P 500. That's usually the index that's used for a relative comparison. So if the S&P 500 is up 10% over the last quarter, a good momentum stock will be up probably twice that, 20% or more. That would be a high relative strength. If the stock is lower than that, that's a very poor relative strength. We're not interested in those. Okay, so those are our four fundamental metrics for finding the market's best hot stocks. How we trade them, that's a whole different story. And we're going to get there, but we have to find these stocks first. And I'm going to show you exactly how to do that here in just a moment. To find these stocks, we're going to turn to two different screening and charting tools. So one set of which is free, the other one of which is not so free. But I have some good news. I'm a partner of this other company, the second company, and I've got a little offer I can make to you to get you started for a low cost. But we'll get to that in just a minute. Let's talk about the free tools first. So we're going to be using a screening tool in Finviz.com. And I'm hoping you're familiar with that site. Many of you probably are. And if you're not, then you're in for some good news, because it's a great free online web-based tool that will give you a lot of resources in a single space. It has a screening tool, it has a charting tool, it has a news feed, it has analyst feeds, it has insider trading information, it has earnings announcements and all kinds of good stuff, all in the same spot. So Finviz.com, you need to use that. And then we're not going to use the charts in Finviz.com because they're not suitable to our purposes. We'll be taking the stocks that show up in our scan from Finviz.com and then take those over to TradingView.com, another free resource. This is now being widely used by a lot of traders, They have nice, clean, clear charts that are user-friendly, and you can go up to annual charts, you can go down to 1 minute chart and everything in between. You can put on there all of your indicators and your technical indicators. The one hitch is that it does limit you on technical indicators, and it limits you on how many stocks you can put in your watch list. And there are a few other limits as well if you have a free subscription to TradingView. It might also be delayed data if you have a free subscription there. But it's still very workable. You can still use it for our purposes here on a free basis. I have a subscription, so I'll show you what a premium subscription looks like, but you don't have to have one. You can do it for free. So we'll start with those two tools, and then we're going to spend a little time with MarketSmith. MarketSmith is a screening and charting and news feed tool that is proprietary to Investors Business Daily. Now, William O'Neill, whose book I highly recommend, How to Make Money in Stocks. I have it over on my shelf. I had to look at the title again. How to Make Money in Stocks. If you have not read it, you need to read it. Read his book before you read mine, because it's a much better book. And some of the things I say in my book come right out of his book, with a lot of attributions, of course. So he was one of my mentors early on when I couldn't figure out how to trade, and I learned from him, and he helped me become profitable. He really did. He got me excited about trading as well, because for him, it is a total 100% 24/7 passion, and that passion was very contagious, and I picked it up. One of the reasons why I was trading in between my teaching at the university. So MarketSmith is not a free tool. It does cost some money per month, and it's not on the cheaper side, but it is an essential tool as far as I'm concerned for trading momentum stocks, because that is their specialty. They are focused, laser focused on helping you find the market's best hot stocks, momentum stocks, and they have proprietary ways of doing that that can't be found anywhere else. We're going to try to match them as much as we can with Finviz, but I guarantee it, we will not even come close. So I'll show you some of the differences here in just a bit. Now, if you want to try MarketSmith at a discount, then I can get you on board for a $20 trial, and you can get the link to that by emailing me at drstocks@drstocks.com. So I am a partner with the firm, but all that means is that I love the product. So I'm talking about it all the time. I'm talking about it on Twitter and on StockTwits and with my subscribers, and I use their charts everywhere I go. So they said, hey, let's just bring him on board. So if you want a trial, you can email me and I'll send you the link to that $19.99, get you started. And it's not a huge fee, but it is more than it's maybe a couple of cups of coffee from Starbucks each day. How about that? So my subscriptions are about 1 cup of coffee per day, and MarketSmith is about twice that. Okay, let's dig into some of the meat here. We've got the preliminary stuff out of the way. This is what Finviz looks like on the website when you first go to the home page, and there's a lot more to it than this. I just kind of cropped off the top, but just to show you what it looks like once you land there. And the tool that we will be using is found right here under Screener. And again, you don't need to have a subscription to finviz.com, but you can open one up. I think you probably have to register if you want to save your screens and save your portfolios, which you really should do. And so you register for free, and then you open up that capacity if you want to do the screening. So once we click on that Screener tab, it's going to come up with an interface that will look something like this. And I'm going to be creating this screen live for you here in just a minute. So you don't need to furiously write all these parameters down, but these are the parameters that we will be using to find the market's best hot stocks with Finviz. Now, I can guarantee the list we get from Finviz will not match the list we get from MarketSmith, and that's because of the proprietary metrics that MarketSmith uses, but we will come up with a very good list of sustainable uptrends. Not every stock that passes this filter will be in an uptrend, so we have to be selective, but I'll show you some ways of doing that, okay? And then once we have our short list of stocks from Finviz, we're going to take those over to tradingview.com, which is your free charting software, and it's web-based. It's not software, it's web-based. And you're going to create your watch list, which will show up over here, right? And then you're going to configure your charts. I have a daily chart always up, and then an hourly chart. This other one is the hourly chart over here on the right, which gives me a sort of modified intraday view of the stock I'm interested in. And then we can always go down from there to the 15-minute chart, the 5-minute chart to pinpoint our entry. And I'll show you some techniques for doing that. And over here on the watch list, you would simply click on these. One click and it will populate the chart in both the daily and the hourly, or however you have it set up. And you're good to go. And it's free. So now again, I think the free version is with delayed data and has some restrictions on how many indicators you can put on the charts, that sort of thing. But to get past that, to get to the very lowest level of subscription service, it's really not much. I think it's maybe about 15 bucks a month, something like that, which I would recommend doing if you really want to take this seriously, but you don't have to. You can do it in the free version. Okay, a couple more things here. Now, when we get over to TradingView, we're going to be building out a chart with parameters on it or indicators on it that we'll be using as a kind of template for our chart analysis, for the technical analysis. Remember, we're using technical analysis to determine our entry, our stop price, and our target price. So these are indicators that, or parameters that I particularly use. If you're experienced at trading, you probably have your own chart set up, and everything I'm telling you here will work just as well with whatever setup you're comfortable with. So you don't have to change to mine. I'm just going to show you what works for me. There are 1,000 different ways of making a profit consistently from the market. I'm teaching you the ways that work for me. And I've been trading since 1996, right? I've been trading for 24 years. Now, the first 2 years were, first 2.5 years were not profitable. It was the third year that I made the transition to profitable trading, and it's been profitable ever since. Okay, so chart parameters that I recommend are, first of all, start with a candlestick chart. We're not going to go over candlesticks today. You don't need to worry about candlestick formations or anything like that. That's a whole nother course. And frankly, with the advent of high frequency trading and algo programmatic trading, candlesticks have far less weight now than they used to. I'm sorry to say, if you're a big fan of candlesticks, I'm going to throw out a little bit of a curveball here for you, but I'm not a big fan any longer. The only thing that I look at with candlesticks is it red or green? That's it. A red candlestick means the close is lower than the open. A green candlestick means the open is lower than the close and indicates on an intraday basis or on a candlestick basis, bulls or bears are in charge. That's all I need to know. I don't care about hammers or dojis or evening harami, morning baby abandonment, all those kinds of strange candlestick formations. They mean much less now because, unfortunately, of high frequency trading, and that's just a sad fact in today's world. Then we're going to place over the candlestick chart a set of exponential moving averages, all set at 34 periodicity. Now, people always ask me, why 34? Well, because I learned it from one of my mentors. Um, gosh, what is his name now? Guy who's at stockcharts.com. McGee? Is it John McGee, or am I confusing him with the founding father of technical analysis? Anyway, it'll come back to me later. Famous John, who writes a column at stockcharts.com, many years ago taught me about the 34 EMA bands, and I've been using them ever since. Now, John Murphy, thank you guys, you're right. You're going to set these bands at high, low, and close. I'll show you how to do that. It's very simple. Always at 34. Now 34 is a Fibonacci number. It's halfway between, not halfway, but it is between 21 and 55, right? So it's in the Fibonacci sequence, and 21 and 55 are very close to the two standard simple moving averages that a lot of investors and traders use, the 20 and the 50 period moving average. Now, if you don't know what a moving average is, you don't have to know. Just wait until you see what it looks like on the chart, and I'll show you why they're so important. Then we're going to add on the 200 simple moving average. And this is kind of your granddaddy of all moving averages. When a stock hits that level from above, it is very oversold. Typically, when it hits it from below, it's very overbought. And a lot of attention gets paid by big time investors to the 200 period moving average. So we need to know where it is. It doesn't factor much into our overall trading. So it is the one thing you could probably do without if you don't like it. But I do have it on my chart nonetheless, just as a kind of reference point. And then we're going to put on the RSI, which is set at the periodicity of 14. Some traders like to go down to 5. That's a little too noisy for me. 14 gives you a broader view. I don't use the RSI as much as I used to. I used to use it a lot for overbought, oversold conditions, and I have found that those are not nearly as reliable, particularly in a market like this where it seems like we hardly ever go down, right? All the economic factors that are propping up the market now are just on full force, and we're not getting much in the way of oversold readings. So RSI is not really that helpful in a market like this on a daily chart basis, at least. But I'm going to show you a technique that I use it for that will help you pinpoint your entries and also help you get out of a trade once the profit has been dried up. And it worked pretty well for that. Not 100%, but it does work pretty well. And then lastly, I put on a volume indicator with green and red candles, which is something you can easily do in most of your charting packages. It might be white and black, but same thing. And you can do that in TradingView also. And once you have those parameters in place, I'm sorry, no, I don't have a picture of that. This is the MarketSmith tool. And this is, you know, if Finviz is a VW, then MarketSmith is a Mercedes-Benz. And I say that kind of with a little pain in my heart because I just had to take our Mercedes into the shop for some issues, which I don't care to mention because the bill was in the 4 digits, pretty healthy 4 digits. So we're not going to talk about that today, but in any case, you get the point. It is what Finviz does on steroids, and it does it proprietarily, which means that there are metrics in the scanning tool for MarketSmith that you'll not find anywhere else. And Investors Business Daily is famous for these things. So I'll show you some of those here in just a little bit. This is what the charting tool looks like. It's not the greatest charting tool, but there are some features on here that are extremely helpful for pinpointing your entries and exits. And I'll go over some of those. And it's a very reliable, robust system. Finviz can sometimes get a little bit glitchy. Sometimes it'll let through charts that you think, how did that ever pass my screens? Well, that never happens with MarketSmith. It's very robust. Okay, when you dig down into the scanning tool for MarketSmith, you're going to see something like this. This is a summary of the scan that we'll be building in MarketSmith. And so here you have the parameters. If you're going to use MarketSmith tool, these are the parameters you would want to copy. And I'll show you some of these are a little bit variable if you're not getting enough stocks coming through. In this particular run, we got 36 stocks coming through. But if you want more than that or less than that, you can tweak some of these. So you have on here your EPS rating, your relative strength rating, your SMR, that's proprietary to Investors Business Daily, and it stands for sales, margins, and return on equity, we talked about already. Current price, 50-day average volume, and then some EPS estimates, which will help us get on board stocks that analysts love. You don't love a stock, you don't love a company unless you're raising earnings estimates on it, and we're going to look at some of those. Okay, and I tell you, I ran both of these screens this morning, and the Finviz scan produced some very nice looking charts, some very nice ones, but a lot of stocks I'd never heard of before. Then I ran this scan over in MarketSmith, and it came, I mean, they were like the who's who of growth stocks. You know, all the big marquee names came through the scan. So I'll show you what that looks like here in just a minute. Okay, now I'm going to end my slideshow here and go to a website. So give me just one moment. I'm going to have to shift over to I have like 4 big monitors here. I have to decide which one to use. So this is Finviz. You should now see my Finviz page. And can everyone just give me a Y or yes if you're able to see Finviz right now? Okay, good. We're all good. Okay, so here's finviz.com, and just a quick run through of some of the features on this site, and I do recommend it. It is free and it's got all kinds of good stuff, but you probably want to register for a free account so you can unload and unlock some of the features. So you've got an intraday chart for the Dow, the NASDAQ, S&P 500, and you know, we were talking about this in our live trading room this morning. I did some chart work for my members yesterday afternoon on the indexes and determined that the QQQ, which is the NASDAQ 100, looked like it was very, very tired and ready to pull back. And then we did some work on the small cap index and determined that, wait a minute, this small cap index, the Russell 2000, is actually looking very bullish. I mean, very bullish. And so that's a what do you call that? What's the phrase? Anyway, when you have 2 competing ideas in your head, the cognitive dissonance, there's some cognitive dissonance there, because if people are buying small cap stocks, they are taking on risk. They're very happy to take on risk. So I think what we're seeing in the NASDAQ 100 is that it's been driven by these big, you know, the big fangs, right? You've got Amazon, Facebook, Apple, Tesla's not in there, I don't think yet. But you know, these big cap, mega cap stocks that are getting all the money, and they've just been going up and up and up and up. Google and so on, hitting all-time highs. And now I think you're going to start to see money coming out of those big caps and going into the lesser known names, the under the radar names, a lot of cloud names, a lot of AI names, a lot of IoT names that haven't been hitting their all-time highs. I think you're going to start to see some of those. And that's what I think is reflected in the Russell 2000. So we saw that and we said, you know, should we like get heavy on the short side today? Well, we had a couple of hedge positions on in the inverse ETFs. We sold one of them right off the bat. I'm glad we did because it just went down from there. And we put on a bunch of longs, which so far have done really well today. So you have to be nimble in this market because it's not going down anytime soon. And we can see it's not going down today because we've got this strength of rally going on. So you've also got all kinds of stocks over here that are making strong gains today. Most of these are penny stocks or small price stocks. I usually don't pay too much attention. All kinds of stocks that are going down today. You've got stocks that are making certain technical patterns. This can be quite a helpful thing. You've got a news feed, you've got economic news, you've got insider trading, and you've got over here on the right side earnings releases coming up before the bell, after the bell, all kinds of stuff. But our interest today is in the screener. So let's click on the screener, and here is your interface. You want to click over here. You've got descriptive, fundamental, technical. You want to click on all because our screen is a bit of a mix. And let me just get out my notes here. Okay. Here we go. So we're going to start down here in the lower left-hand corner, and with a price filter, I want my stocks to be over $20 per share. If you are more interested in trading lower price stocks, that's fine. You just fiddle with this. You can put this under $20 per share if you want to. But keep in mind that we are looking for sustainable uptrends, strong companies, fundamentally sound companies, and you're going to find fewer of those in the lower priced range. So price over 20, volume right here, average volume, we're going to put this at over 500,000. This is one of those you can fiddle a little bit with. If you're getting too many candidates passing your screen, you can raise the volume, average volume. If you're getting too few, you can lower it a little bit. I certainly wouldn't go under 300,000 though. You really want your stocks to be well traded. You want them to be easy to get in, easy to get out of. You want there to be a lot of attention to these stocks from funds, from hedge fund managers, and those trading large accounts, because those are the guys that are going to drive the price. Now, with these two filters in place, we're already down to 1,400 stocks, okay? So we're starting to whittle down our list. The next thing we're going to put on here is an EPS growth of, going back over the past 5 years, over here, EPS growth past 5 years, and we just want this to be positive. 1% is all we need. We just need to show that the stock is not expected, or the stock hasn't been losing earnings or constricting or contracting its earnings over the past 5 years. It's in fact been growing its earnings. We want that. We want a strong 5-year track record. Now, in putting that in place, you're going to rule out already any IPO that launched within the last 5 years. Some of those are excellent, excellent stocks. MarketSmith is a great way to trade IPOs because they keep a list of the best IPOs going, and that gets updated every day. So that's usually a very good list to start from if you want to focus on IPOs. We've gotten in on several in our live trading room over the past year and a half, right from that list. That's where they come from. Okay, EPS growth 5 years, and then EPS growth this year. EPS growth this year of over 25%. Now that's a big number. Anything over 25% is a company that did really, really well this year. Now, earnings growth can come in all kinds of forms, from a genuine increase in product acquisition, or it can come from cutting back on costs. Either way, it's a good thing. You want to see a company earn more money than it did last year. That's what we want for the sustainable growth that we want. EPS growth next year. Now, this is, of course, just an estimate, but we want companies that have a favorable sentiment going forward, very bullish sentiment about what's coming down the pike. And if a company is expected not to grow next year, that's not the kind of sentiment we want, right? So we want to filter out those companies. This is also a metric that you can fiddle a little bit with. If you're getting too many companies, you can raise it. If you're getting too few, you can lower it. The same is true with EPS growth, but I would not go lower than 20%. 25% is a good number to stick with. Now we want to look at sales, because, as I just said, you can grow earnings through sort of negative means, reducing your costs, your overhead. But there's only one way to grow sales, and that is to sell more product. And if that's what you want, you really want a company that is selling more product. And we want a company with a strong track record of sales growth. So we're going to go sales growth past 5 years. We just want it to be positive. Don't want any negative guys in there. We want lots of positives. Now we're going to go to return on equity. We have return on investment. We have return on equity. We have return on assets. We want return on equity, and we want this to be at 20% or higher. This is a fundamental part of the MarketSmith SMR metric, and we're actually able to replicate it right here in Finviz for free. So that's a good thing. Now we're going to go to margins. There are three types of margins. There's gross, operating, and profit. But not every growth company, not every sustainable uptrend has real profits. They're still in the growing phase and haven't yet, made their first buck. They're still losing money. And so they're not going to have a profit margin to work with. But operating margin, if you do not have positive operating margin, you're in bad shape. So we want operating margin set at over zero, greater than zero. Operating margin is how much money the company is making with the exception of taxes and interest on debt. So, everything else being equal, if there were no taxes, wouldn't that be great? And if the company didn't have any debt to pay off, then it would be doing really, really well. And that's what we want to see. We want to see good operating margin. Now we're going to go to analyst recommendation, and we're going to set this to buy or better. So we want the average analyst covering the company to have a very positive view of the company going forward. Here's the thing that Finviz cannot do. It cannot separate out good analysts from bad analysts. It can't tell you, who's got that 75% track record and is earning at least 20% every time they make a recommendation, because they just don't do that. That is something that MarketSmith does. It does have some ways of filtering that out. Okay, so we have analyst recommendation. Then lastly, we're going to set RSI at the 14-period moving average, or 14-period periodicity, and we're going to set that at not oversold. Oops, to move one of my screens here. We have to set that at not oversold and greater than 40. So we don't want a stock that's in a downtrend, and we want stocks that are at least in the top 60% of all stocks relative to the S&P 500. Now that's a rather low threshold. So this is one that I tend to fiddle with quite a lot. This scan that we've got gives us 30 stocks. That's a pretty good amount. I usually like to have 40 to 50, but 30 is okay. So I'm not going to fiddle with this anymore, but if I had, say, 50 or more, I would raise this to not oversold over 50. That only knocks out 4 of our stocks. So let's leave that in there for now. And here's what we're going to do. We are going to run our scan. Actually, it runs for you. You've got a list down below. We are going to save this list as a portfolio. And yes, we want to create, let's just create an equally weighted portfolio. And let's name this portfolio. We'll just call this webinar stocks. And we'll save. And now, once we have this portfolio open, we can do a number of cool things. We're going to open this portfolio in our screener. And now we can sort these stocks from a variety of angles. We can look at their relative valuations, and then we can see, who's got the lowest PE ratio, who's got the best price to sales, who has the best EPS this year, and the worst EPS this year, right? They're all above 25% at least. And we can do the same for some financial metrics. Here's return on equity. Who's got the highest return on equity? That would be Lowe's. We can look at some technical perspectives. How far away are they from major moving averages? How far below the 52-week high? All that kind of stuff. We can sort by RSI. So APPS, one of the stocks we had in our trend trade letter, but we sold too soon because it's gone way up, has the highest RSI, no surprise there. And we can do all kinds of fun stuff, but where we're going to start is with Snapshot. Snapshot gives us a quick look at the chart, and a quick look at company fundamentals and technicals, all in one quick view. Now, I'm going to scroll through these and I'm going to write down a few names. I'm just doing this from scratch because I did not run this scan this morning. We just built the scan, in fact, just now. So I'm going to take some notes for myself on which of these charts look like they have favorable setups for us to consider. And then we'll take that short list and move on over to TradingView and drill down into the chart and see where we can find a good entry price, stop price, and target price. And that's the process, right? This is your free version of the process. Okay, I'm going to rule off apps right now because it is way too high and it's just been going straight up, and anything greater than a 45-degree angle uptrend tends to not be sustainable. That's something I teach till I'm blue in the face. And if you want to know what a 45-degree angle looks like, draw a line from left lower corner to upper right-hand corner. That's your 45-degree angle, and you can measure the current angle of the price relative to that, and you can see this is more like a 65-degree angle right here. Nothing wrong with this uptrend. Fine if you bought it down here, right, on the breakout, but it's just gone a little too far too fast. Lowe's has some potential. It's not a very exciting stock, right? Big cap blue chip stock. Starting to coil up under 160 right here for another little breakout move, but let's see if we can find something a little more exciting. CPRT, Copart, I'm not familiar with this, although I'm familiar with the ticker symbol, is going flat right here, which is quite nice. Even as the market has been a little bit choppy, it's gone nice and flat. So I'm going to mark down CPRT. And we can see it's trading still under 105, which is where it sold off on the February crash, the COVID crash. PG, we'll skip that one. Lulu is a great trading name and one that we trade, we used to trade quite a bit in the trading room. We haven't traded it for a while, but it's already in breakout mode. You can see that the June highs posed as some resistance. It coiled up under that area and then broke out to the upside early this month. And it's been in a nice uptrend ever since then. And it's now running into some price resistance. That's the purple line there, which Finviz nicely draws in for you. So I'm not interested in stocks at resistance. I'm interested more in stocks near support or below resistance. Something like this, Red G. Oil and gas refining, I'm going to pass on that because I'm a scarred trader of energy stocks. And I'm just passing on most energy stocks these days. HZNP is, it's a drug maker. Looks like they came out with earnings recently that did really well. Anytime you get a big pop like this and a lot of consolidation, you can see price trying to form its pattern in here for weeks on end. Not really the best place to buy it for a trade. But this one looks pretty good. This is MasterCard. I like MasterCard. We've traded Visa. The calls on Visa a couple days ago did really well. And MasterCard is in a nice consolidation. We'll look at the chart of that one. Let's get a couple more and then we can move over. TPX, Tempur Sealy, is one of those strange retail stocks that can be an excellent trading vehicle. It can really get moving. It's got a lot of beta to it, if you know what beta means, relative to the S&P 500. And it's coiling up quite nicely here. It's got a little green candle today. Let's put TPX on our list. And we already know that these companies have strong sales, strong growth. So all that stuff has been done. We're just now trying to find some good charts. Pfizer, big cap generic drug maker, looks really good. I mean, this is a very nice looking chart. You've got price running up against this resistance line at around 39, and it's now pulling that back down into a nice little shallow handle off this big cup. That's a bullish pattern, cup, handle, right? But it's not the most exciting stock to trade. So while I do recommend going long here, Pfizer, we're not going to look at it in TradingView. Let's see if we can find one more. Low G, that's kind of a strange looking chart. CDNS has some good stuff going forward. And that's actually, I have to say, CDNS is one of my long-term positions. I've been in it for a couple of years now. It's one that I recommended to our members back then, and I bought it myself in our long-term portfolio, not in the live trading room. So if you're in the live trading room and saying, hey, we never heard about that. No, it was in my Ichthus letter. And it looks like it's ready for another big leg higher. So I like this one. Now, we've done our preliminary work. We've got 4 charts to drill down into: CPRT, MasterCard, Tempur-Pedic, and Cadence Design. What we're going to do now is take these over to TradingView. So we'll click on TradingView here. Let me get to a couple of questions here, by the way, while we're transitioning over to TradingView. And so I don't have too many left at the end of the presentation. I will be taking questions at the end as well. And let's see, how can you get in early on the Airbnb IPO? I have no idea. You'll have to consult with if you have a financial advisor, they usually have some insights into that, and financial advisors can sometimes get you in if you're a accredited investor, but it's the kind of thing that's not usually available to most retail traders and investors. Tesla, PE, yeah. No, actually, I've been in Tesla since 170, unsplit adjusted, and I'm not selling anytime soon. My price target is 4,000, which would be 20,000, I guess, split adjusted. So I'm going to be hanging on for a while. Let's see, can you show us how you went from saving portfolio to the current screen? I think I just did that, but if you didn't answer that question, if I didn't answer that question, please ask it again at the end and maybe give me a little detail so I understand what's being asked there. Yes, the recording will be sent out to everybody. Do I check with float? I don't necessarily, because for the most part, the stocks that pass through this filter are stocks that have a relatively larger float. Not all of them do, and of course, float has to do with how fast a stock will move when supply and demand shifts. And anytime a supply and demand shifts and you've got a smaller float, there are fewer shares to go around, and so that pushes the price up more quickly. But we are not that concerned about it, really. It doesn't factor into the process that we're learning here, but it certainly can be something you want to look at. Leap options, we don't do anything with leap options. Right now in the room, live room, we're trading weekly options. So we're really scrolling down to the very close expiration. We traded one today. What was it in? Zoom Media. It was expiring tomorrow, and within about 20 minutes, 30 minutes, we had a 60% gain, and we sold it right away. So that's the kind of thing we do in the live trading room with options. Let's see. Yes, switch to TradingView. Do you use the same filters for scanning ETFs? Well, Andre, you can't scan ETFs for fundamental metrics like that. You can't look at earnings or sales or return on equity, because those are all company-specific things. And an ETF is a whole bunch of companies, so you can't do that. ETFs you can only scan for in terms of technical indicators. So I do have an ETF scan, which I use for my ETF trend letter, but it has no fundamental metric in it at all. Okay, borastic margin, I have no idea what that is. That's a new one, Dan. I've never heard of borastic margin. Okay, let's get back to the charts, and I won't create a watch list because we only have 4 stocks. I'll just type these in one by one. And let's take a look at CPRT. So here we have the daily chart on the left and the hourly chart on the right. The hourly chart has the metrics on it that I suggested you put in. The daily chart only has a 4 EMA and 9 SMA on it, which I sometimes use in one of my trading systems, but I'm not using it now and won't be using it here. But what I like here is the hourly chart. Let me blow up the hourly chart. This is what the hourly chart looks like, and I'll show why this is a nice looking trend chart. We already know the company's good, right? The company is one of those companies that has strong earnings and sales and return on equity and margins, and the analysts like it and all that good stuff. And the chart is up. Look at these 34 EMA bands. You see how nicely they form a nice ribbon going up, 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 and then they start to flatten out here where the price is consolidating. That's a good thing. We don't want to see the 34 EMA bands roll over and point down, but we don't mind when they go flat because that indicates price is consolidating. Let me draw an arrow in here, and clearly this is an uptrend. Now, a couple of things that would cause me to be a little bit worrisome here is that if we drew a line under the dominant pivot lows, which would be starting here, to keep moving the question box because it covers up my chart. We start the trend at the pivot low in late July. We have another touch here on July 20th. This is an hourly chart, remember, so we're looking at several bars per day, 9 bars per day to be exact. And then the 31st of July, we have another touch. And then we have a series of touches up here, which happened yesterday, or day before yesterday, I'm sorry. Let's zoom in on that. Another nice thing about trading views, you can kind of fiddle with the charts to get a better picture. So we have a number of touches right here of that dominant trend line. And then yesterday it opened below and never regained that trend line. This morning, like the rest of the market, it opened down even further, rallied up, and we're still in the bands. So I'm concerned about this because we have now broken the dominant trend, which means we're in no man's land. Typically what happens when you have this occur, you get a pullback in price, then you get a nice bounce into the underside of that trend line, and then you get a really big drop down. We don't want to get caught up in any of that right now. So CPRT is a pass on our determination of where is a good entry. But if you had come across this chart, right about here, put a box on that. If you had come across a chart right about there, buy it. By all means, buy it, because that's the third touch of the dominant trend line, which you had established back here in mid-July, and it touched again in late July, and here we are touching it again in early August. I think that's early August, late July, very late July, with a nice little green candle, all kinds of good stuff going on there. We're down into the bands. We're down into the 34 EMA bands, but that typically acts as support. Ideally, you don't want to see price go down into the bands. You want to see what's going on here, where the bands act as support from the upper edge. You want to see price kind of touching the top of the bands, fiddling around with them, not necessarily going into them and then pushing off. When you do get price going into the bands, you don't want to see it close below them. And that's what's going on here. We've got them in the bands, but not below. We start to reverse out, and here is your entry point. Now, if we can drill in a little closer, we can figure out our entry point. If you had come across this chart on this green candle right here with a high of 91.76, your entry point would be 2 cents above that, 91.78. 91.78 is your entry price. Okay, so you're in at 91.78, and a couple of days later, you're trading up to 97, 98, 99, 100, right? So all good stuff, all good stuff. So that would have been a very nice entry. Now, where would you have put your stop loss? Well, there are a couple of places, but and some people use stop losses as a percentage of their total investment. So for example, if you have a risk tolerance that says, I will never take a loss more than 6% on any one trade, then if that's your hard and fast rule, then you would simply put your stop loss at 6% below your entry price, whatever that would be. 91.76 divided by 1.06, whatever that is. I prefer to have dynamic stops. By that, I mean I want stops that are relative to price action itself rather than a predetermined percentage. And one of the best ways of doing that is you definitely want to have your stop loss below the dominant trend line. That's the black line. You also want to have your stop loss below the lower 34 EMA band. And you want to have your stop loss below the lowest low of the most recent pullback. So in this case, the most recent pullback is the day before entry, this day right here, July 31st. Hold on a sec. And that the low of that day, which is 91.17, is just a tad lower than the 34 EMA band. So I would put my stop loss probably down below 91, like 90.88. Now that's a relatively small loss on a $90 stock. I got in at 91.7, what did we say, 91.76? And I'm willing to risk about $1, maybe a little bit less than $1. Okay, so that's actually a low risk trade. I'm risking less than $1, and I made $7 or $8 if I caught the meat of the move. Okay, now, so we've determined where to set our entry. We've determined where to set our stop. I like it in a dynamic fashion, which is to say below the support line, below the 34 EMA bands, and below the most recent pivot low. Now, the most recent pivot low can sometimes be a little bit subjective. There are ways of putting pivot prices onto the chart. TradingView will do that. Most of your charting packages will do that. So if you need some help determining a pivot low, that would be a way to go. But that's what I would do in this particular trade. Now, where to determine where to take profits, which is the fun part of the trade. Now that's a little easier, but it doesn't always work quite the way we want it to. You're in right here on this yellow box. I'm going to just use this green line. You want to draw a line over the preceding pivot highs. So draw a line extended out to the right edge over the most recent pivot highs. 2 of them are all you need, but 3 or more is even better. The more touches you can have of that line prior to your entry, the better. It will establish that line as a very solid place of resistance, a place where people are going to start to take profits, and the stock is going to stall out. Doesn't necessarily mean it's going to fall, but it does mean it's likely to not go up any higher for a while. And that's where you want to get out. You don't want to sit in there for ages. Then time starts working against you. So you can see that this actually gave us a very nice exit. If we can drill in on that green line, we can see that we got a touch, I think on this day, right after the open. And it was right around the open of the day, about 98.21. So we got in down here at 91 and change. We got out, looks like about 5 trading days later or less at 98 and change. Very nice multi-day move. Okay, let's take a look at another chart. That was CPRT. Let's take a look at MA, which I really like, both fundamentally, because it's not just a credit card company, right? Everybody knows that. It's not a credit card company. It is all kinds of things. It's a data analysis company. It's an artificial intelligence company. It's a it's kind of a PayPal sort of company. It's a Shopify kind of company. It's got tentacles in all kinds of businesses. All right, let's take a look at what's going on here. So we've got, let's go to the daily chart first, take a look. So down here we have the March lows, which was the COVID low, and it's been in a strong uptrend ever since. In fact, it tagged a low of about 200, and here we're up at 330. Very, very nice return so far. But it's not yet trading at its all-time high, which was set back in February. February. So we're coiling up in a move to get up there, and I would determine that my own determination is that it is probably going to be your price target based on prior resistance. Now, to determine our entry price into this, we have to get a little more creative than the little pullback that we saw on the previous chart, because this is a breakout stock. This is not a trending chart that pulls back. This is a chart that coils up and then shoots up to the outside. And we are currently, as you can see from this chart, we're currently now beginning to break out to the upside in a brand new move. Let's go down to the hourly chart. And see if we can't figure out where we could have gotten into this. Now, in my estimation, this is the kind of stuff that you don't want to buy. See all this choppy here, all this choppy stuff? You've got the 200 period average going flat. You've got the 34 EMA bands looking like a roller coaster, up and down, up and down, up and down. Remember CPRT? Those 34 EMA bands looked just like a straight arrow, like a nice golf swing that flies out 300 yards and just goes up and up and up. And who's that hitter on the Nationals? We live in DC, so that young guy, what's his name? I'm not a big baseball fan, but I followed them last year, of course, because they kept winning. In any case, it's like one of his home runs. But this doesn't look like that. This looks like, I don't know what it looks like. It looks like a roller coaster, and we don't like that stuff. This is a great day trading chart. This is the kind of chart you would want to trade with weekly options, or just buy the shares and sell it a few hours later, maybe a couple of days later. It's not the kind of thing for a good swing trade. But having said that, we are in this nice looking pattern right now. Coil, 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 breakout. Coil, 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 breakout. We've also got the 34 EMA bands beginning to trend up quite nicely, right? They're in a consistent trend since down here. And that gives us our place to draw in a dominant trend line, which would look something like that. The supporting trend line for the current move looks just like that. Let's zoom in a little bit. The 34 EMA bands tip us off to the dominant trend because of the consistent upside. And we've got lots of touches down here at the beginning, lots of touches down here at the end, not a whole lot in between, but that's fine. And we've got some nice push into this dominant trend line, and then the breakout move that came yesterday and was confirmed again today, despite the gap down off the open. So we have some resistance highs that it's running into right now. So right now is not a very good time to buy it. Where should we have bought this? Well, we could have bought it right here on this dip into the bands, tagging the dominant trend line, confirming the dominant trend line, which was confirmed or established back here at the beginning of the trend. We've got a nice green candle. We're still within the 34 EMA bands. We're not below them. All of that is good stuff. That would have been a nice place to buy it in anticipation of the breakout move that we're now seeing. I would not buy it here unless it pulls back down into this former resistance line, now support, because we might see a test there. And if we see a test there, then it will likely precede the next leg higher. The other place to buy this would be on a breakout of the current level of resistance with a view to holding it until the all-time high up here at 348, which would be a very nice move indeed. That would be something like 335 and change up to 348. You could trade that with some options, maybe 3 to 6 months out, maybe some 350s on the call side. That would be a very nice move. Okay, so determining our profit target is easy enough because we have this former area of resistance that gives us our target. Where would we put the stop? Well, we would use the same rules we used before because we have a dominant trend line. We have some pivot lows. Let me see if I can highlight those. We have certainly a pivot low here. We have a little one here. And then we have the low of our entry place. And you would certainly want to put your stop loss below the dominant support line, below the 34 EMA bands, and below at least this pivot low. To be really safe, if you were wanting to hold this longer term, you would probably put it down here below this earlier pivot low. So you would have it, you would start it at around 321 and change. Always make sure that you are trailing your stop up. So as the stock moves in your favor, you're moving up your stop loss. That reduces your risk. And once you get past your entry point, it protects your profit. Okay, let's take a look at one more and then we'll switch over to MarketSmith, TPX or CDNS. Let's see which one. This one has, let's go to the daily chart. No, that's not too bad. Let's CDNX. This one is in a, I mean, let's just admire the beauty of this chart. This is just a beautiful chart because you've got a classic uptrend. Now, look, here's your, oops. Here is your dominant trend line, and I want to try to capture as many of these pivot lows as possible. That's always what you want to do when you're drawing in your dominant support line. You want to try to capture as many of those pivot lows as possible, just on the outer edge of them, the tails of them. That is a very clear dominant trend line. We've got no violation of that trend line. We've got price on every pullback staying above the 34 EMA bands. You can see now why I use the 34 EMA bands. They give a clear indication of trend. They offer you clear area of support. In a downtrend, they offer areas of resistance. And I'm perfectly fine with buying stocks that pull back into the bands, but I'm not fine with buying stocks that have closed below the bands. Okay, let's just make that a hard and fast rule. This is just a beautiful uptrend. And of course, every one of these little pivot lows would have given you a nice entry spot. Okay, let's just say this last one here. Let's say we came across the chart on that particular day. So we're looking at the chart on the far right edge and it looks just like that. We've got the dominant trend line in place. We've got the 34 EMA bands just floating higher so gently, so nicely, 45-degree angle or less. And we've got this nice green candle. Where are you going to enter? So this printed a high of 99.22, 2 cents above that. That's my rule. 2 cents is 99.24, which hit the next day, and you're in the trade. Your pivot stop loss, your dynamic stop loss. Okay, let's draw in some pivot lows. Here's your most recent pivot low that's very clearly defined all the way down to the 34 EMA bands. Here's one a little bit further back. This one back here, that's too far back. We don't want that to be our stop. We always want our stop below the dominant support line. That's the black line. We always want our stop below the 334 EMA bands, and we want it below the lowest pivot low. That would put our stop loss right about about here. And that's at 89.61. What did we see our entry was? 99.22. Okay, so that's a 10-point stop loss on a $100 stock. That's a 10% loss. That's a little bit, well, sometimes you have to take that kind of a risk. And if you're going to take that kind of a risk, 10% or greater risk, then you will want to reduce your position size, right? If you normally buy $5,000 of a stock, you might want to go down to 3,000, something like that, because you are reducing your risk and you want to manage risk. That's one of the big things that we teach, right? Manage the trade. That's one of the ways you manage it. But you could also have put your stop loss, and you know what? That stop loss isn't even where it would have gone. It would have gone below the 34 EMA bands all the way down here. That's too far. So we're going to use the pivot low on the day before our entry. We'll call this the signal day. And we're going to stretch this down below the 34 EMA bands to right about there. That is 91.80 on a 90, what did we say it was? What's the high? 99.24 is our entry. So that is less than, it's about $7 and change on a $100 stock. That's a little more reasonable. With something like that, I would be going full size. So we trail our stop up as the trade matures. I do like to keep them below the bands if possible, but sometimes, you know, when it goes way up like that, you probably would move it up to about here, keeping a little bit of a distance, trading it up to about here. You're going to leave it in place while the stock begins to trail off, and you would be getting out of this trade at 106.40 for about a 6.5% gain. Okay, now let's move over to MarketSmith, and we'll do this all over again using the Cadillac. Let's call it a Cadillac rather than the Mercedes-Benz, because I'm still suffering from that bill that I got the other day for all those repairs, those expensive Mercedes repairs. Okay, here we are. Hopefully you can see my, let's go to daily view. So here we are in MarketSmith, which is a tool of Investors Business Daily. And this is not a free tool, as I said before. You will need to purchase a subscription, a monthly subscription, but it is well worth it. And if you email me, and I'll give you that email again, drstocks@drstocks.com, I'll send you a link and you can sign up for about 20 bucks as a nice trial. And it'll give you plenty of time to get a feel for it and determine whether it's going to be helpful for your trading. I will not trade without it. I find it not only saves me a ton of time, but it also gives me a far greater list of stocks that pass through the screen. Now, your screening tool is over here on the left, and you can see that I've got a number of screens already programmed in. And I've got the scan for today already programmed in, and I've done that because I wanted to save a little time. And let's see, we want to open edit. And here is the scan that we'll be using for the purposes of this webinar. Some of these filters can only be found in MarketSmith. You'll find them on their Investors Business Daily's website, investors.com, in prepackaged form. So they'll tell you, you know, what are the stocks showing the best EPS rating? What are the stocks showing the best RS rating? What are the top comp stocks? What are the top 50 stocks in growth? What are the top 250 tech? You know, things like that. What are the top IPOs? It will give you pre-scans like that. But MarketSmith also gives you all of that. All I can do is click on a mouse, click the mouse once, and I've got the top IPOs at my fingertips. I've got the top tech stocks at my fingertips. I've got stocks making breakouts. I've got stocks making pullbacks, all prepackaged for me. But I like to do my own scanning, my own technical analysis. I don't like to rely on other people for that. And so this is why I built this particular scan. This is high quality growth stock with relative strength. It's that kind of scan. And I'll show you the parameters here. Okay, so we've typed in for the EPS rating, this is proprietary to MarketSmith, a score of 90 or above. So we want our stocks, EPS is the, remember we were looking at past and future growth. Well, the EPS rating here takes both of those into account. It factors in past growth, it factors in the growth for this year, it factors in growth quarter on quarter, it factors in growth forward projection over the next quarter, factors in growth for the next year. All of those are then crunched into some sort of formula, and it spits out a number between 0 and 100, 1 and 100. And if it's above 90, if it's 90 or above, it's in the top 10% of all stocks for all of that growth. So, and that's the kind of stock we want. So we've done that, and this is a number you could fiddle with. If you're getting too few stocks, you can go down to 85. If you're getting too many, you can go up to 95. You can fiddle with that a bit. Relative strength. We want stocks in the top 15% at least of all stocks relative to the S&P 500 based on price performance. This is the one technical indicator we have in here. And I've set that at 85 to give me at least 15%. The top 15% stocks on a relative strength basis. Again, you can fiddle with that number to get more or fewer stocks passing through your filters. The SMR rating, that's sales, looking at past, current, and future sales, margins, and this takes into account gross operating and profit margins if there are any. Even a company that doesn't have real earnings yet has a negative profit margin, and that can be greater or lesser. So it is possible to factor that in. And we want companies that are at the very top. They have an A rating or better. You can get an A plus in this category, I think, but at least an A. We want an A. The M stands for margins. The R stands for return on equity. And William O'Neill determined that the best growth stocks, you know, he did this experiment, right? He looked at, I don't know how many, 2,000 stocks that performed the best in the market over the past 30, 40, 50 years. And he said, what do these all stocks have in common? One of the things they all had in common was that they had strong return on equity. And I think that's because, as I said before, it is a function of conservative, smart management. These are guys who know how to run the company well, efficiently. They're doing really well with the assets that they have. Okay, so we want a rating of A there. And then I have an EPS estimate percentage change over the next quarter. That's something we can't do with Finviz. And I have that, I want that to be positive. So I've got in here a 1% at least. So I want the analysts who cover the company and the company management itself to be saying publicly that in the next quarter, they're going to earn more than they earned in the last quarter. That doesn't always happen. In fact, during the market crash, it was very rare to find a company that was raising earnings estimates. They were all lowering them, right? They're all saying, I'm sorry, but because of the shutdown, the lockdown in the economy, we're not able to make as much money next quarter as we did last. And they all came out and warned. We don't want that. We don't want companies that have done that. We want companies that have come out and said, look, we're actually surprised that our widget is selling in Mongolia in a way that we never predicted. And by golly, we're going to have to raise our earnings estimates. We want companies that are doing just that. We want that near-term pricing pressure is evident in the next quarter. And we want, going down to number 7, EPS estimates to be rising for the current year. So anytime that a company comes out and presents their earnings, they also say, look, over the next fiscal year, this coming fiscal year, or is it the present fiscal year? I guess, I'm not sure. We're raising our estimates. And that could be coming from the company itself. It can be coming from analysts. It doesn't matter as long as it is factored into this estimate. And then we want something forward, right? Future earnings. We want to see future earnings rising, and that's what number 8 is about. So we've got 1s in each of those to give us at least a positive number. I've got my price set at 10 That's a little low. I'm actually going to change this to 20, which typically you don't get many stocks that pass all these filters with a price below 20 anyway. But I do prefer the higher price stocks because they tend to be the more stable stocks, lower risk. So I'm going to put that in at 20. I've got my average volume at 500, and that's all I need to do for my scan. And this produced, then you come over here and you've got a review of the scan itself, how many stocks have passed through. And in this particular run, we've got 42 stocks that passed through our filters. Now keep in mind, in Finviz, we had 26. In MarketSmith, with a more robust scan and proprietary materials, we've got 42. So already we can see the difference. We click on the view the screen results. And in a few seconds, we've got a list down below of our passing stocks. Okay, click on each one, double click, and we get the MarketSmith chart. We'll put our filters away and look at this list. We've got stocks like Adobe, AMD, Amazon, Alibaba reporting earnings tomorrow, big, the Chinese Amazon, right? CDNS, now there's one that is common to both. Clorox, eBay, right? A lot of familiar names. JD.com, one of our favorite traders. There's Lowe's, that was on both lists. Monster Beverage, Netflix, ServiceNow. These are all companies that are the bread and butter of traders, right? If you're an active trader, you trade these names every day because this is where you make your bank. So that's one of the things I like about this scan. It's very robust and it has this knack of teasing out from all the companies trading the best trading vehicles. Okay, so let's see if we can make a short list of stocks to look at, and then I'll show you how the charts in MarketSmith work. They work a little differently than TradingView. They're not quite as suitable to our needs because we're trying to pinpoint entries and exits. But they do have some unique features that make them very compelling and make them a nice add-on, a nice value add to the work that we'll do in TradingView. So we'll get back to TradingView in just a little bit, but let's see if we can find a couple of stocks from this list that we can look at. We still don't have, by the way, we still don't have a couple of good entries for you, and I do want to leave you with that. So let's see if we can find some from this list. I want to find my drawing tool. I never draw on this. I'm not going to draw on this. I'll wait till we get over to TradingView. But Adobe, you can see it is forming this very nice little consolidation base up here. This is what William O'Neill would call a high-level base. It's about 3 weeks long, or is it more than that? No, it's more than that. It's a couple of months long. We've got higher lows. We've got some clearly marked pivot highs at the 470 and change resistance. And this, by golly, looks like it's about to break out. So I like this one. I'm going to write down Adobe and see if we can find, if we want to trade the breakout of this, where is the best entry? Where's the best stop? Where is our target price? Finding the target price on a pattern like this is very easy. So we'll look at that in a moment. AMD, oh, nice little pullback here. I want to take a look at the hourly chart and see what's going on under the hood, so to speak. Ooh, I like this one. If I were trading right now, hey, if you're in my live trading room, guys, go long AMD right now for a day trade because it looks like it's ready to pop. This nice little pullback here with a pivot low and then gapped up the next day. A lot of tech stocks did that. The whole NASDAQ did that. So nothing surprising there. It rallied for a while and then it pulled back into this nice little shallow cup or handle. Maybe it's the handle to this cup, something like that. I can also kind of see a little left shoulder, head, right shoulder, although it hasn't broken out of that yet. But what I like is that it's starting to rally slowly here off of this little rounded bottom. I really like rounded bottoms as a I don't mean that in anything other than trading, but a rounded bottom breakout is one of your most stable patterns. So look for those. This is a good one. And back to the daily chart, I'm going to put this down because that is a nice little pullback. It's not the kind of pullback that I like to see, but it is tagging the 20 period moving average, and big green stick today, big blue stick today. RSI is at 95. That's a good, if it's up around 99, 98, that's too much, but 95 is a good place to be. Of course, the fundamentals over here, and this is where MarketSmith gives you an edge, are very strong. You've got EPS rating 99. You can't get any better than that. The group rating, semiconductors, A+, can't get better than that. SMR of an A. Accumulation distribution, which is how many shares are going on the buy side, how many shares are going on the sell side. A B+, that's very good. 99 comp rating. Timeliness is the technical setup, that's A. Growth rate 159%, anything 3 digits is excellent, excellent. Anything over 25% is very, very good. And over here, we've got earnings estimates up for this year and up for next year in strong double digits, all good stuff for sustaining this uptrend. I mean, it had a very sharp move, and this is why you don't want to buy something up here. You're going to be a bag holder because that's sharper than a 45-degree angle. It's not sustainable. And you just don't buy there. Okay, let's take a look at Amazon. I know because we were in calls yesterday and got almost a double on this move right here, this breakout move. We bought them at 28 and went all the way to 56 for a double, but I got out the next morning at 54. Very, very nice trade. And this is in breakout mode. So gosh, guys, there's too many nice looking stocks here. I really don't think this market's going to go down anytime soon. I mean, I've been worrying in the trading room about a major pullback, and we're just not seeing it. We're not seeing it in the major leaders, and that's where you would expect to see it. Okay, now this one's a little weaker, and I would not be interested in ASML right here because we're printing a lower high on the daily chart. And after this pullback, the pullback itself, there's nothing problematic about that, although this gap down is not that healthy. But now that it's printing this very weak bounce back, that's looking more like, from a pattern perspective, like a bear flag, and anything to the downside is going to be very vulnerable to a sharp move down. So I'm not interested in that as a long. AUDC is actually one that we have our live trading room and my trend trade letter members in, and we got in back here on this, on the end of the pullback at the 50 period moving average, and it got off to a very nice start. We were able to move up our stop a little bit, and then the last 3 days it's been not making me very happy. And it started off well today. It looks like it's not doing very well today either, but we've got a stop in there. A stop will prevent us from taking anything major on the loss side. This is one of your top rated software as a service plays, and it's a great long-term hold if you're interested in that, but right now it's not looking that great. So I'm going to pass on that one. Baba's coming out with earnings tomorrow or tonight, one of the two. Or did they already report? Looks like they reported this morning. Not much of a move, if that's true. But actually, I kind of like this little pattern it's forming in here, this little symmetrical triangle. You can see a clear support resistance line over the tops, support line over the lows. Now, where to enter into something like that is a little tricky, but I'm going to put that down as a potential breakout candidate, and let's see what else we can find. This is, I'm not interested in that. It's kind of rolling over. This one is nice, CHD. I don't know the company, but because it's not a big familiar name, I'm going to pass. This one is Sienna. Oh, Sienna. Former high flyer from my early trading days when we used to make $30, $40 in a day on this stock, and it's come way down. But looks like it's doing a little bit of a pullback into the 20-period moving average. Sustainable uptrend, very strong fundamentals. Let's see if we can find an entry on that one. So I'm going to write down Sienna. Let's do one more. No, not that one. Let me go back to that one and explain why I don't like that one. So a big earnings gap. Is that earnings gap? No. Looks like earnings was back here. Something, what is this? A CLGX mortgage. Well, for some reason, maybe it's a buyout. It probably got an offer to be bought out, which typically creates this kind of pattern. Big gap up to near the offer price. And of course, the offer isn't going to be met right then. It takes weeks for the lawyers to hash everything out. The offer can always fall through, so there's always a little bit of a downside risk, but usually they do go through, in which case you lose all your shares at the buyout price. And so because of that reason, it has no upside. There's no more upside. There's no reason for the stock to go any higher than the buyout price, probably with $70 a share. And the stock's not going to go down because it's going to be bought out at $70 a share. So, you know, why would anyone want to sell their shares, you know, or short it? You're certainly not going to short it. So all of that's to say that it's not going to go anywhere until it finally stops trading, in which case you just leave it, you just let it go. You don't even look at a chart like that. That one is printing a bear flag, which I don't like, although it is above the 20. That's a nice looking uptrend, beautiful uptrend, but there's no entry point there. I'm looking for something that might give us an entry today. That one's got potential, eBay, but it's got a little double bottom and it's breaking out of that double bottom. But I don't know, for some reason it's not speaking to me. Not that one, too high. This one is, ooh, that one's dropping. Don't like the look of that one. ENTG could be a short candidate. That one's already in breakout mode. Nice looking chart. This one's a nice pullback, but it's below the 50, below the 20. I'm sure it's below the 34 EMA bands. You can see relative strength. It's dropping off a cliff. Not a good stock right now. You might get a little bit of a bounce back into the 50, but that's about all you could hope for. JD is one that showed up on a lot of traders lists this week and last week. Good stuff there, but already in breakout mode. Okay, all right, let's start with what we have. We've got 5 stocks, and I don't know if we'll have time to look at all of them, but let's type them in one by one. We'll start with a daily chart of Adobe. Now let's see if I can identify for you for today and tomorrow some reasonable places where you can buy this and exit at a profit, and where you can minimize your risk on the downside. Okay, Adobe, excellent company, been around for a long time, lots of good growth potential, doing all the right things, excellent management, and it's about ready to break out. So we've got this pivot low here. Oops, let's do that again. The most recent pivot low into the bands, fine, no problem with that. It's not below them. We've got another pivot low a little bit further back right here, and we've got a pivot low kind of in that area, all within the bands, all good stuff. They're getting a little bit higher, that's good. The current price is right at previous resistance, on the way to breakout, and this is a very strong, look at that, just big green stick today. What does the volume look like? Yeah, the volume's pretty weak, I have to say. What time are we at? It's almost 2 o'clock. The volume is not even half of what it was yesterday, so probably not going to break out today, might not break out tomorrow. But here's where I would buy this. I would buy this 2 cents above the previous high, which is 470.61. Let me mark this down, 470.61. we had 2 cents, so 63, 470.63 would be your entry price. We're just, 15 cents below that right now. And you would put your stop, let me use a yellow box here for the stop, below the pivot low, below the 34 bands in this area right around 425, 426 would be a good place to put your stop. So that's, $45 on a $470 stock. That's almost 10%. So that's a little bit, whoop, we just hit our entry price. We're now long, Adobe. Frankly, I don't think today is the day to buy it because that volume is so low. I think you're going to get some more coiled up weakness under this line. And if that happens, you want to scroll down to the hourly chart. Here's where you can use the hourly chart to give you some reasonable levels. So look, it's already we're already making money. You've already paid for this free webinar with your first trade. I don't know if anybody took that, but anyway, I'm just a little bit concerned about the volume today. But it is August, and all the big traders are on the beach or of their Hampton home, and they're not really trading anyway. So we don't expect volume to be too much. And also volume tends to be much heavier on the downside than it is on the upside. Those are just universal truths. So if this does pull back, this is the area that you would want to buy it in, around 460 into the 34 EMA bands. If you get any kind of a pullback in there, that's a nice place to lower your risk, so you don't have to take the 10% stop. But another thing you can do actually is set your stop on the hourly chart, in which case you could move it to maybe right about here. You're under the 200 period moving average, you're under this little pivot low, and you're under the bands. So this is at around 442, which cuts 17 points off your risk, which is very good. And then if it does succeed to break out, you would just trail your stop loss up like that. Now, where do you take profits on a breakout like this? This is the easy part. This is the easy part. Let's draw in our dominant trend line, and we can do that underneath these lows. So we have a 1, 2, almost a third, a fourth, 5, 6 touches of that dominant trend line on the hourly chart. That's the easy thing to see. Now, take a look at this. Let's draw a box around this. This is the movement within that range. It's ended right here at the right edge. It started at that pivot high. So that's the range of this current pattern. Halfway between these two vertical lines is your pattern midpoint, and we'll just eyeball it. It would be right about here. And so let's take a price check on that. Point right there is 427.83. I'm going to draw this down, 427.83. And we go all the way to the top, your breakout line, 470.62, 470.62. We subtract the one from the other. Let's just get rid of the cents to make it easier, 43. So we have a range of the pattern of $43. You would simply add that to the breakout pivot, which we said was what, 470 and change. So add 43 to 470, you get 513. 513 is now your target. So 513 is a $43 move. We don't want a $43 stop. So to really minimize the risk, you would have to put it clearly up here and trail it up on the hourly chart basis, which actually is a very good idea. I think it's a very good idea. Okay, so you have a couple of choices. You can buy it right now and set your stop at around 443 and your target at 513 and trail up your stop to reduce risk over time. Or you can wait until it pulls back into this little yellow box. Manage the trade, that's the key. Let's look at AMD. one of my favorite trading vehicles. Okay, a couple of things on this. First of all, this right here is a beautiful uptrend, but never, 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 never think about buying it when it's this far into that uptrend. When it's gone this far, greater than 45 degrees, just wait for the pullback. You'll get one. You're either going to get a pullback, or if it's a very, very strong chart, you'll get some sideways choppiness. But either way, you don't want to be stuck holding those shares for weeks on end while price is reevaluating the stock itself, right? And that's why stocks trade up and they trade down, because of the perceived valuation of the company. That's why we spend so much time analyzing the fundamentals of the company, because without perceived valuation, you're not going to get the uptrend. Once it gets to a place of being overvalued, according to market perception at least, stocks are either going to pull back or they're going to go sideways. Okay, so it's the fundamentals that cause the supply and demand, and it's supply and demand that cause the price movement. And people always forget, they always forget that first parameter, the fundamentals. Okay, so we're not going to buy it there. Where ought we to buy it? Well, guess what? I like it right now. And again, if you're in my live trading room, get long, guys. Go on, you can do it. And I'll show you why. Because price had been printing this very nice looking consolidation triangle. I'm going to ignore that gap down because I don't know why the market gapped down so fiercely off the open, but it was clearly not related to fundamentals because it got back so quickly. This little area of price consolidation after a very, very sharp uptrend is to be expected. It's the kind of thing we would expect. And this big dip below the 34 EMA bands also to be expected, because that is the overreaction to the overreaction of the uptrend. The uptrend went too far too fast. The pullback also went too far too fast. Now, if you're a nimble trader, one of the things I like to do is do a mean reversion trade. When prices get too far away from those 34 EMA bands, they become really good candidates for snapping back to the bands. If you're a nimble trader, you could have bought it down here on perhaps a valuation basis, or maybe it's outside the lower Bollinger Band, or you could use all sorts of ways of measuring mean reversion. And I have a whole manual on our site that teaches you how to do that, by the way. A little bit of self-serving pitch. But anyway, we got the bounce back into the bands and into the bands. There's a little wavy action, and then now today we have the breakout. So on a consolidation triangle like this in an uptrend, here's what we expect. The uptrend was too far too fast, but we do expect it to continue because that is the dominant move. This little sideways consolidation is merely a reevaluation of what's going on in the stock. And how far do we expect it to go? That's easy as well. So we can play with these little arrows here. So we take our arrow. It looks like this uptrend started on the breakout move right there. So let's mark that as our beginning. And it ended, to be safe, I'm going to say it ended right here because it kind of went sideways. Even though it traded up a little bit, it went sideways for the most part from there. That trend was clearly gone at that point. That measures the major move. Then we have the pattern consolidation with the breakout today. All we need to do to determine our price target is take this arrow and put it right on top where the breakout is. And where did it go? It went almost to 110. So to be safe, it'd be about 108. 108 would be our price target. Let's mark that down. Our entry, I mean, we're a little bit past the breakout right now, although not much, right? Your breakout move is right here. So that was a high of 81.65. So your entry is 81.67. We're saying 108 is our target. So that would be a really nice, about a 26, 27% move. And it might get there. If it matches this, it will get there in a couple of weeks. That's a nice trade. Where do you put your stop loss? Okay, so remember, 3 things for stop loss are the pivot lows, the dominant trend line, support trend line, and 34 EMA bands. We want, for the most part, our stop loss to be below those 3 things. Now, it's a little hard to determine the dominant supporting line here because we have all these touches in here because of the consolidation. We have this big pivot low that's very clear. There's nothing unclear about that, but we can't really stretch this back. I mean, I guess we could kind of capture those moves there, but those are really rather, there's not as much information in this kind of gap up pivot as there is in this sort of pivot where it trades down and trades back up again. So I'm going to have to say that our dominant supporting line is that one right there. The bands are clearly marked, and the most recent pivot low, I mean, I guess we could use this morning's opening candle. That's the first hourly candle. This obviously is the previous pivot low before that, but that's a little too far away and too far removed from our entry and too much risk to take on. So I'm going to put my stop loss right here underneath this pivot low, and then trailing it up from there as the trade matures. Okay, so there's trade number 2. You want to get in at, I mean, right now it's 82.69. Your stop loss is, let's give a more precise figure, 78.79. That's very low risk. I like that. You're only risking about $3 to make, what did I say it was? 28, 27. Good stuff. Okay, let's take a look at, we'll do a couple more of these here. Amazon, the big daddy, Amazon. Oops. Hold on here, folks. Type properly. There we go. Okay, Amazon is the market these days. I mean, it is the bellwether. It is the big papa, the big kahuna. Okay, so we have, very similar to the AMD chart, we have a breakout in progress. I'm sorry, the Adobe chart. We have a breakout. We have a clearly marked dominant supporting line. That's good. I like that. This is a nice uptrend because, I mean, look at these bands, right? Up, 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 up. There's no flatness there. Every little pullback hits the bands, but doesn't even close inside the bands, just tags them and pulls back. That's why you can see how important these 34 EMA bands are in an uptrend. They're almost worthless when stocks are choppy, but that's true of all moving averages, right? Moving averages only work in uptrends or downtrends, but that's why we're using our relative strength filter, because we want to find uptrends that also are growing and have a measure of safety. So this is a great looking breakout chart. It has already broken out, so we're a little late to the game, but that's okay. Current price, let's mark current price as our entry. It is now at, zoom in a little bit here. My mouse is so sensitive. Okay, there we go. 32.92, we'll just forget about the change. 32.92 roughly is our entry. Now, previous entries that you could have really gotten in nicely on would have been above the high of this green candle on that little pullback, and this little red candle pullback followed by a green candle push off. Anything in there, anything close to that support line would have been a very nice lower risk entry. Lower risk because you're closer to your stop loss than up here. The problem with breakout candidates is that you can't just put your stop loss underneath the resistance line because too often you get tests of that line. You can get a chart that just chops up and down, up and down, up and down that resistance line for several weeks. And if you're buying every breakout and selling every dip below the breakout point, you're going to lose a lot of money. You're going to get whipsawed like crazy. So you need to give a breakout room, and that's why breakout trades carry more risk. But the advantage of a breakout trade is that you have very little in the way of resistance. I mean, this is up at all-time highs, I'm pretty sure. And so there isn't any area of price resistance. Now there is this little area. Okay, forgot about this little tricky little spot right there. It hit, this was a few weeks ago, and it hit 33.37 and got slammed. That was not on earnings, and there may have been some news, may have been that the market itself was just in a mood to roll over, but that's your classic profit-taking kind of enough is enough, we've gone too far too fast, the company's overvalued, and the analysts come out and downgrade, and that's what happens. You get that kind of stuff. Now, here's the problem. A lot of people bought up here around 33.25, 33.30. They bought all those shares. They're still holding, waiting to get their money back. What happens when it gets back up there again? All those people are going to start to sell. So knowing that, I would go light into the stock right now and heavier once it clears that. Once it clears that on the close, not just on an intraday basis, but on the close, you can add on some more shares. Okay, where to put the stop? Now on a daily chart basis, let's draw in our pivot lows. Remember, stop, 3 parts of the stop. Pivot lows, supporting line of the dominant trend, and 34 EMA bands. So ideally we want our stop below those 3 things. This is your most recent pivot low. That looks like a nice place. And below the bands, we put our stop right about here, which is a price of 29.34. And we're gonna have to figure out where our target is to determine whether that's a good spot or not. And if that's too much risk, we can go down to the hourly chart and figure that out. Okay, so this is a pattern. It's a breakout pattern, and we can say it started right about here and it broke out on that day. So that's the width of the pattern. We find the midpoint, just eyeballing it right about here, and we do our price check. So 28.90 and 32.30, 28.90 and 32.30 is 300 points or so. I mean, 32.30, 28.90. I need a calculator. 340 points. So we tack that on to the top of the breakout. 340 plus 32.50 more or less is 35.90. We'll just call it 3,600. So 3,600 is your target on this move, which is right here. Not much of a move, but it's a tight pattern. Amazon is not, one of those stocks that moves very fast. But if you play this with some maybe 3,800 calls going out 3 months or so, you could see that quadruple or more by the time it gets up to 3,600. So that would be the way to play this. I think my stop is a little too far away, too much risk for too little reward. So I'm going to go down to the hourly chart and see what we've got going on here. Let's get rid of all this stuff. Okay, so here you can see more clearly this area of resistance where price got slammed. And we can see the higher pivot lows were well above the 200 period moving average, all in the good stuff. So we'll do the same thing we normally do. We'll draw in first our supporting trend line. We can even go way back here and draw in that. That's a clearly marked supporting trend line. We want to be below that. We want to be below the 34 EMA bands. We want to be below the most recent pivot. It looks like kind of this rounded bottom would be your most recent pivot. So we could put our stop. This is also nice because it's just below the 200 period moving average on the hourly chart, which should also act as some support. So we're down here at 30.92. That's much better. Yeah, that adds about 150. It takes off about 150 points of risk. So that would be a better trade. So you put your stop here and you're looking for 3,600 on the upside. And again, I would buy half now and half on a close above that resistance line. Okay, one more. Let's take a look at Alibaba, Chinese internet retailer. Wow, well, that was kind of messy, actually. Let's take a look at Sienna, which is the other one we had. Okay, nice little pullback here. Nice little pullback chart. Now, this isn't a major pullback, so if you look at previous pullbacks like this one right here and this one right here, that's a slam. That's not even a pullback, that's just a slam. And then we have, kind of a minor pullback here. We have a little shallow dip here. So what this tells us is that the stock has been making pullbacks, but most of them, 3 out of 4 of them, have only been to the top edge of the 34 EMA bands, and that's pretty much where we were 2 days ago. So in other words, I'm not expecting this to make any further pullback. Now, sometimes stocks will make pullbacks in a A, B, C pattern, something like that. So you always have to be sort of wary of the next leg down, which can happen to any stock at any time. But from a lower risk perspective, I like the fact that it has pulled back. We're not playing the breakout. The breakout was already played back here, right? That was your breakout move. We're getting a pullback, not all the way to that breakout pivot, but we're getting it to the bands at least. And I think if we go to the hourly chart, we'll see a little better way of playing this. Yeah. Let me get rid of the drawings. No, maybe not. Yeah, actually, I'm not as excited about this as I once was, and I'll show you why. Because on the hourly chart, this is your, come on now, this is your dominant trend line with 3 clear touches, and it has now violated that. So to me, it looks like we're going to get another leg down. We are going to get an ABC pullback, probably to the 200 period moving average around 58. That would be the place to buy it. So don't buy this now, but if you want, you can put in a limit order, good till canceled at 58. And if that filled, I'll show you where you would put your stop. Let's go back to the daily chart. So the most clear recent pullback is that one right there. That's not a nice one, although once you get down to 58, it's a little less, not quite as bad. Let's draw in our dominant trend line, clearly this one right here. And in this case, if we got this, ABC pullback to 58, and we started to see it move higher, that would give us a pivot point right here at 58, okay? That would be the pivot point we would key off of. The 34 EMA bands would be in that same area. The trend line would be there. So our stop loss would be somewhere below those 3 things, about 56 and change, 56.15. And you would just trail it up from there. That's a nice low risk trade. Sienna is, big mega blue chip. It's not going to be moving very fast anytime soon. It's not It's not like some of the others we've looked at, but nice, safe swing trade if it gets down there. I wouldn't buy it today, though. All right, you do have 2 trade entries in Amazon and AMD. So all that's left to do now is, let's get back to our PowerPoint. And sorry, I'm gonna have to fast forward through this. And I'll get you over to the correct screen. All that's left to do now is give you your offer for our services. If you would prefer me to select the stocks for you and tell you the entry price, the stop loss, and the target price, and manage those trades on a day-to-day basis, then head on over to drstocks.com. That's our flagship site, drstocks.com. And any annual membership, if you attended this workshop today or watched it in the recorded version, simply sign up for any one of our annual memberships and then shoot me a quick email, and I will go to our merchant account and issue you immediately a 40% rebate on your purchase. And you can hold me to that. If I don't do that, you can call the Better Business Bureau. Sick them on me. We have our 3 primary flagship premium products. They're Trend Trade Letter, which comes out every day. ETF Trend Letter comes out every day. The Momentum Letter comes out weekly. It's our most profitable letter. So any one of the mailing, any one of the annual the annual subscriptions there will get you that 40% discount. I also offer webinars that teach you how to chart read. Some of the techniques that we're using today are taught there. And I have a brand new pullback trading webinar that's available on our site if you're interested in that. I've also got manuals and a number of other things. I would also love to have you join our live trading room, which is over on stocktwits.com. It's called Dr. Stocks Trading, the Dr. Stocks Trading Room. But if you have any problem, just send me an email. We also have our sister site, drstockstrading.com, and there's a lot of demand for those letters, and I cap those at 200 members each. One of them is almost closed. I still have about 10 slots left in the penny stocks letter, but you can go over to that site and take a look at those. I can't offer discounts there because of the demand, but you can take a look at those. And in any case, email me at drstocks@drstocks.com, drstoxx at drstoxx.com if you want the MarketSmith discount coupon, which will get you into a nice trial at $19.99. Email me if you have any other questions. I love to help people learn how to trade. That's my passion. We do a lot of teaching in the live trading room throughout the trading day, explaining what I'm looking at, and we do some chart talk every day and all kinds of good stuff. So that's maybe the best value, but that's over on stocktwits.com. Okay, I am going to pause here and see if there are any remaining questions that I didn't get to before. There are quite a few questions in here. Yeah, there are actually a lot of questions, so I might not be able to answer all of these. Can I go over how to set up the 34 EMA bands? Yeah, that's actually, that is a crucial step in our process, and it is very simple. So you would go over to indicators and you click on built-ins, go down, scroll down to moving average exponential, click on that. So actually I'm gonna have to, here's what I have to do, because I don't have access to all the indicators because I don't need them. So I'm going to delete my 34 EMA bands and then put them back on. I have a subscription, but I have not their highest one, so I'm limited in how many indicators I can put on. Here we go. Moving average exponential. I'm going to click that 3 times, and then I go over here to arrange the settings. So click Settings, go to Inputs, 34, and then I will select High. Okay. And then I do the same for this one, 34. I'm going to select Low. Okay. And then I'm going to do the same for this third one. Close, already a close. And that gives me my 3 bands. Now I fiddle with the style because I like them different colors, I like them thicker, but that's how you would put them on your chart. Okay, next question. What are the black and green lines? And what are the black and green lines on the chart? Well, the black lines are the trend. The green lines, I'm not sure what green, I guess the green lines were the arrows that I was drawing in. So those were just add-ons that I drew in to show you where to put your stop loss, where the supporting trend line is, and so on. You use 1 hour chart, why not use a daily chart? Any difference? I use both. So I do my initial, as we saw, I do my initial filtering on the daily chart, and then I scroll down to the hourly chart if I need to pinpoint my entry and my stop loss. But I use a daily chart for the most part for determining target price because you want to see the whole pattern. You want to get a good big picture of what's going on. What account size do you feel would be required to justify the monthly expense of MarketSmith? Well, good question, because yeah, you want to make sure that your trading profits are outweighing your overhead costs. And when your trading account is, say, under $10,000, you want to keep your overhead costs very, very low. And by the way, let me give you a good tip here that I wish someone had mentioned to me when I was starting out trading. I always assumed that all brokers were equal and that I should just select the broker with the lowest commissions. And I tried that for a while, and I tried all kinds of different brokers, and I realized that that's not how brokerages make their money. Brokerages make their money by working the spread between the bid and the ask. So you might say, you know, I want to buy a stock at 38.28, and the broker will actually fill you at a lower price and then sell those shares back to the market at a higher price, and that's how they make their money. One of the things that I found out is that there are brokers, Interactive Brokers is one of them, and that's the one I use now and have used it for years and years. They offer price improvement. So if they can go into the market and get you a lower price than what you're bidding, they will do it, and they pass on those savings to you. So you will pay them the commission fee, which is also very low. I'm only paying a fraction of a cent for every share. So it usually works out to, you know, unless I'm trading a small cap stock or a penny stock and I'm buying tens of thousands of shares, it usually works out to a lower commission than what I would be paying at a big house broker. You know, someone like a Schwab, where you might pay $30 to get in and $30 to get out. I'm paying $5 or $6 or $7 each time. And I trade quite a few shares. So if you've got a smaller account, you're going to be trading 100 shares. 100 shares, you're going to be paying 50 cents, right, to get in, 50 cents to get out. It's almost nothing. And when they get you a better price than you're asking, you're saving money. Also, Interactive Brokers has the lowest margin rates by far. And they give you money on your long shares because they lend out those shares to short sellers. So if you're willing to do that and there's no cost to you, they'll pay you interest. So it's all good stuff. Okay, let's see. Tesla 2000 today, and I missed it. Oh man. Yeah, we've been long Tesla for ages. And I said on StockTwits that it would hit 1900 at the end of the month, meaning August. And it hit it within like 2 or 3 days. And of course, it then dipped back down and went back up again. I really didn't think we'd be at 2000 so soon. Short interest screening, yes, Vinil, there are plenty of ways to set up screens to find great shorting candidates, but that's a whole different ball game. That would be a whole different webinar. Okay, I didn't answer the question, by the way, about what size of an account. It kind of depends on how profitable you are. If you are trading a $10,000 account, then you ought to be averaging, I mean, if you're working with me, you ought to be averaging about $500 a month in profits, okay, about a 5% monthly gain. That's not huge, but $500 a month will pay a lot of bills, right? I would think that would justify using MarketSmith, which is around 100 something per month. But to be fair and to be really honest, I would rather see you build up that account to twice that, about $20,000 a month, in which case then you're making $1,000 a month on average, you know, and we're always thinking in averages because one day is different from the next, and that would justify the expense. I think a $20,000 account, if you're successful, would be a good account for a MarketSmith subscription. Is Cadence a buy? Cadence is always a buy. Just buy it and hold it. Don't sell it. Same with Tesla. Same with Amazon. The number of stocks that I like forever and ever. Those are three. Do I provide options recommendations? I have an options letter on MarketFi, which I mentioned at the beginning of this webinar. And if you go to marketfi.com, you'll find it there. It's the #1 letter of all the ones that they sell in terms of performance. But we also do live option trading in the live trading room on StockTwits, so that might be a good place to start. Let's see, does Zacks Wizard compare to MarketSmith? Now, I do use Zacks Wizard as well. So I use Zacks Wizard because of the Research Wizard because of the backtesting feature, and I use it to build fundamental trading systems because of that feature. But I do find that because it only updates in the evenings, it does not update throughout the day, and MarketSmith updates every second, right? So it's not as good for the kind of short-term trading that I like to do. It's very good for longer term. So if you're holding a stock any longer than a week to a month to maybe several months, then it's a good tool for that. It has proprietary Zacks research, which is excellent stuff, really, really good stuff. Their Zacks rank is top notch, but it doesn't have the MarketSmith branded metrics, which I really prefer because they're more oriented towards growth. Zacks is more about value. MarketSmith is more about growth, just in general. 34 EMA bands. Now, if I said 23, I made a mistake. It's 34 EMA. Can you show Intel on MarketSmith? Sure. Let's take a look at Intel. And did a nice little day trade this morning in Intel following. Okay, come on, computer. I've got too many things open at the moment, too much streaming data coming through. So Intel has had this really nasty earnings crash, and I haven't really, I mean, it's not a stock I trade very often. It just happened to come up on my screen today because a lot of options players were piling into shares. It does seem to me like, I mean, you've got EPS rating at 98, you've got SMR at A, you've got a green triangle for this year, which is good. You've got a 20% growth rate, which is solid for a big cap like this. And you've got like a nice, if you drew a supporting trend line underneath all these big pivot lows, you'd see that it's a lot closer to support than it is up here at resistance. So it's got a lot of upside room with not as much downside danger. So not a bad place if you're willing to hold on to it for several months, because I don't see this doing a whole lot near term because of all this overhead supply. As soon as you get up here above 50, it's going to get slammed like it did today, right? It tapped 50 and it got slammed. We wrote it up for, I don't know, 20, 25, 30 cents. It wasn't a big trade, but that was just a little day trade using options. So not something that wasn't in the room, by the way. If any of my room members are there, that was just a little trade I had on my own that I didn't have time to call. Okay, back to the questions. What accounts I know? Why did the market not retest the March bottom? Well, it didn't retest the March bottom, and this is the easy answer, because the selling was way overdone. I mean, the selling was based on COVID models that we're talking about millions of people dead in this country, and none of that ever happened. It was clear early on that none of that was ever going to happen. So the selling was clearly way, way, way overdone. And then what I don't think people expected was that a lot of businesses really got very flexible and creative and started finding ways of making money from the lockdown. So someone like a Zoom Media opens up and it starts skyrocketing, and you've got Amazon because everybody's shopping online, and grocery stores are delivering to the front door, and pretty soon people are saying, hey, this is not so bad for a lot of companies. Now, of course, your casinos, your hotels, your airlines, your travel agencies, they're all hurting still, restaurants, but they are beginning to come back. And you're going to have a much smaller competitive space because you've got several chains that are going out, they're going bust, and which is unfortunate, but that is a reality of what is being faced now. And so you're going to have the bigger players gaining more market share and swallowing up all those little guys. So all of that's positive too. Then of course you have a very dovish Fed. It's pumping money out there. You've got low inflation. You've got a weak dollar. You've got countries repatriating, coming back into the United States. All kinds of good stuff. It's all good news. So of course the market's gone up from there. And of course this wasn't going to double bottom because the first bottom was such a farce. That was the one thing. We started going long in middle of March. And I was on StockTwits and I'm saying, this is it. I mean, the bottom is in. We got to start buying stocks. This is the best opportunity of maybe our generation. And so I had our members in the live room. We went heavy long and we held. And then we started, 3, 4, 5 weeks later, 6, 8 weeks later, we started peeling off these double-digit and triple-digit gains. We had several triple-digit gainers from those deep sell-offs. And of course, that's what you got to do, man. When the blood is in the streets, you got to buy. And when everybody else is thinking sell. Okay, that's my little soapbox for the day. Let me get one more question here. Are those bands available on paid subscription? Yes. Do you have to keep adjusting your stop loss manually every time it moves up to protect gains? No, you don't. You can set a trailing stop loss with your broker at a certain percentage distance from current price or a certain dollar distance from current price, and then it will automatically adjust throughout the trading day. So easily done. You can do that. You don't have to manually move it up. Do I prefer MarketSmith to Leaderboard? Yes, because I like to pick out my own stocks. So Leaderboard is IBD and their panel of investor analysts selecting stocks for you, and they tell you, buy it at this price and put your stop loss here and sell it at that price. And they do okay. If you check their track record, it's like maybe 55% of the trades make money, and they might average the average gain per trade is pretty low. To be kind of honest about that, it's maybe 0.5% if you look at it long term. Our short-term trades, we have a 69% win rate, and we are averaging in our very short-term swing trades, we're averaging 1.24% per trade. So a fair bit better doing it myself, and I'd rather do it myself. Okay, my email address is, maybe I can type it in here. No, I don't know how to. Anyway, my email address is in the PowerPoint, and you'll see it if you review the webinar. But if you want to write it down, it's drstoxx at drstoxx.com. Okay, I think that's about it. I think I got earnings, email address. No, well, I don't offer any free trials. I'm sorry. Yeah, my big thing in the trading room is weekly options. I'm seeing quite a few weekly options questions here, and they give you the best bang for the buck. The best thing about options is that your downside is limited, and when you go out 3, 4, 5, 6 months with an options contract, you are adding on premium, which means your risk is that much bigger. Your risk is that you have that much more to lose. With a weekly option, I mean, you can do really well trading just the SPY options, SPY, and sometimes you'll get those if you're going up a couple of strike prices, you can get those under $1 each, 60 cents, 70 cents each. You're risking very, very little money, and they can double, triple, quadruple sometimes. We had a 500% gain in one a couple of weeks ago in just a matter of hours, right? In a single day, you can score big with a lower downside risk. So I really like weekly options, particularly the near term. So like tomorrow, right? Tomorrow's Friday. A lot of weekly options expire tomorrow. And we're going to be trading several of those because all the price premium is out. All the time value is out already, almost all of it. And you can almost trade those like you're trading the stock itself. So of course, I mean, you have to know if it's going to go up or down. That's the key thing, right? You can't just buy it and hope for the best. But if a stock is almost at the same price, I mean, let me put it differently. If the weekly option has no more time value, it's trading with the stock price, then it's like you're trading the stock with 100 times leverage. It's just a beautiful thing. So, and the other thing we like to do, and I don't happen to do this very often, but sometimes we will sell way out of the money put options on a high value stock. I do that quite a bit with Tesla because, if Tesla is trading at 1800, you can go all the way down to like a 1400 or a 1500 put with 1 or 2 days left, and you still have $100, $200, $300 worth of time value there. And there's no way that Tesla's going to drop 300 points in a day. So that's like just money in the bank. It's beautiful, beautiful. Of course, you have to be careful. If Tesla does start dropping 300 points, you want to get out of that thing before the expiration. So you'd have to keep an eye on it. But it's 99 times out of 100 it's going to work your favor. Yes, someone asked for 40%. If you go with all 3 bundles, yeah, if you bundle stuff together, just assume that you will get a 40% rebate to me on the total, and you just shoot me an email and I'll do that. And that includes the webinars and it includes manuals. So if you buy a whole bunch of stuff, shoot me an email. I'll total up your shopping cart and we'll deduct 40% from that and give that back to you as a credit, as a cash credit, not as a purchase credit. Using margin. Well, Devonte, I think that, hi Devonte, you're a friend of mine. I think that margin, if you ever have a chance to use margin, you should. Now, not every account has the availability or the possibility of using margin, but you should always, if you have a choice between a cash account and a margin account, if you have that choice, take the margin account every time. Because the margin account will give you the option to short, and that gives you so much more potential during market pullbacks and during bear markets. You're going to have to short stocks if you want to stay afloat during a bear market. And secondly, if you're day trading, you can begin to add a little bit of leverage by going over your account size. Now, I don't recommend doing that unless you have strong trading skills, but once you do, you'll find your returns are increasing, not exponentially, but they are increasing. Now, I myself dip into margin almost daily when I'm day trading, but not much. I might go in 1.3, 1.4. I don't go all the way to 4 times, which is what I have the option of doing. I just don't have a stomach for that. But yeah, do I add 30, 40, 50% on top of my account when I'm day trading? Yeah, of course I do. Because I know I'm watching that trade like a hawk. I've got, I know exactly where I'm going to get out. I've got my risk managed, and I've got a 72% win rate on my day trades. So I'm happy, I'm content with that. Okay, guys, I am going to stop it here. You're asking for a phone number, but it's best to email me and we can go from there. So guys, I loved spending time with you. I'm going to get back to my live trading room and maybe see some of you in there as well. God bless everybody. Happy trading, and we'll see you soon. Bye now.